Wisdom that advises starting small so you do not blow up your account is undeniably true, yet it remains entirely surface level. It completely misses the actual psychological mechanism at play. It fails to grasp why starting small is not a concession to weakness, but rather a deliberate act, psychological engineering, that the best traders in the world deeply understand, and that you most likely do not. Having spent decades working with traders at every single level, from individuals opening their very first retail brokerage account to institutional fund managers running hundreds of millions of dollars, I can tell you with complete and absolute certainty that the behavioral pattern is always identical. Traders who rush to trade large positions inevitably destroy themselves, not because the market actively punishes them, though it certainly does, but because their own internal psychology punishes them in profound ways they cannot visually see while it is happening. Meanwhile, the select traders who possess the rigid discipline, the patience, and the genuine psychological understanding to start small and stay small until they have earned the right to trade larger are the exact ones who are still here 5 years from now, 10 years from now. Those are the ones who actually make it. And now I need to be very clear about what I mean by earning the right, because this specific concept is where almost everyone gets it wrong. They erroneously think earning the right means having enough capital in their account, having accumulated enough screen time, securing enough wins, or feeling a surge of personal confidence. None of those superficial things are what I am talking about. What I am talking about is something far more specific, structural, and critical to your survival. You have earned the right to increase your position size when, and only when, you can definitively demonstrate that the outcome of your very last trade has absolutely zero psychological effect on the execution quality of your next trade. To state this differently, you have achieved this necessary state when a loss does not make you hesitate for a split second, does not make you angry at the market, does not compel you to tighten your stop loss or widen your profit target. It does not cause you to skip the very next valid technical setup. It means that a winning trade does not suddenly make you overconfident, does not make you sloppy with your parameters, and does not induce you to arbitrarily increase your risk because you temporarily feel completely invincible. When you have reached the specific psychological state where every single trade is executed with the exact same mechanical precision regardless of what occurred on the trade immediately before it, that is the exact moment when you have earned the right to scale up. You cannot, under any circumstances, reach that specific mental state while trading large positions, because it is neurologically impossible to do so. Your brain possesses an ancient threat detection system that is older than language, older than rational thought, and older than any evolved part of your mind that understands probability, edge, or mathematical expectancy. This hardwired survival system, which is centered directly in the amygdala, constantly monitors your immediate environment for signs of danger. It defines danger very broadly. Physical threat is classified as danger. Social humiliation is classified as danger. And financial loss is explicitly treated as danger. When you place a trade that is large relative to your current psychological capacity, not your financial capacity, your psychological capacity, this ancient survival system immediately activates. Cortisol instantly floods your bloodstream. Your heart rate elevates. Your field of visual attention narrows. The exact part of your brain responsible for rule following, systematic thinking, and the calm execution of a tested process gets overridden. This process is not a metaphor. It is literal neuroscience. Prefrontal cortex, which is the rational, rule-following part of your brain, literally loses its structural ability to control your behavior when your threat detection system is fully activated. You do not make rational decisions in this compromised state. You merely react to stimuli. You actively move your stop loss because the immediate pain of realizing the financial loss is psychologically intolerable to your nervous system. You exit your winning positions entirely too early because the intense fear of giving back a small profit is completely overwhelming. You engage in reckless revenge trading because the desperation to recover what was just lost has completely hijacked every other priority in your mind. Afterwards, when the structural damage to your account is completely done, you sit there utterly stunned, wondering how you could have done something so obviously self-destructive. You knew better. You had clear rules. You had a written plan, and yet none of it mattered in the heat of the moment. It did not matter, because your oversized position put you directly into a neurological state where your rules and plans became totally inaccessible. You were not actually trading, you were surviving. And physical survival has absolutely no practical use for a trading plan. This is precisely why starting small is not a limitation to your growth. It is the ultimate solution to the most fundamental problem in professional trading. The problem is not the market environment. The problem is not your technical strategy. The problem is that your nervous system treats financial risk as a direct physical threat. And when that threat is large enough, it takes over. Starting small keeps the perceived threat entirely below the activation threshold of the amygdala. It keeps your prefrontal cortex fully online and functioning. It keeps you in a calm state where you can actually follow your rules, systematically observe your own behavior, and develop the solid neural pathways of consistent execution. I know exactly what you are thinking right now. You are thinking that if the stakes are too small, the practice does not actually count. You believe that you cannot learn to handle the pressure of real trading by trading tiny amounts that do not pressure you. This common objection sounds perfectly logical on the surface, but it is completely and dangerously wrong. Think about it this way. A commercial pilot does not learn to handle the immense stress of an engine failure by experiencing an actual engine failure on their very first flight. They learn it thoroughly in a simulator, and they learn it at low altitude with an experienced instructor, and then they learn it in progressively more challenging conditions. Each single step builds directly on the neural pathways established at the previous, lower stress level. At no point in that pilot's career does anyone suggest that the simulation does not count simply because the stakes were not real enough. Training counts because the core skills transfer seamlessly. The neural pathways built under low-stress conditions are the exact same neural pathways that intus fire under high-stress conditions. The only difference is whether those pathways are strong for enough to override the panic response when real pressure arrives. Trading is identical. When you trade small and follow your rules perfectly for 50 trades, you are building the same neural pathways you will need when you trade larger. The habits of verifying your criteria before entry, of placing your stop without internal negotiation, of letting the trade reach your target without manual interference, and of recording your execution quality after every trade are deeply neurological. They live inside your brain as physical connections between neurons. Those physical connections get stronger with repetition and weaker with neglect. Every single time you follow your rules at a small size, you are strengthening those disciplined connections. Conversely, every time you break your rules at a large size, you are actively strengthening a completely different set of connections, the ones associated with panic, impulsive action, and emotional decision-making. You are literally building the physical brain of either a disciplined professional trader or an emotional gambler. And the position size you choose determines exactly which one you are building on any given day. Now, let me get very specific about how this works in actual practice, because I am not interested in giving you abstract principles without clear procedures. Principles without procedures are just ideas, and ideas do not change human behavior. Only structured practices change behavior. The very first practice is what I call threshold testing, and it is the foundation of everything that follows. Before you trade anything, before you risk a single dollar in the market, you must identify your current emotional threshold. This is not your financial risk tolerance, but your emotional threshold, the maximum amount you can lose on a single trade without it producing any detectable change in your emotional state or your behavior on the next trade. To find this threshold, you must start at the smallest position size your broker allows. You trade your system with full rule compliance for a sample of 20 trades. After each trade, you record two things. Did I follow all my rules? And what was my exact emotional state during and after the trade? If you followed all your rules and your emotional state remained neutral on all 20 trades, you increase your position size by exactly one increment. Then you trade 20 more trades, utilizing the exact same recording process. You keep increasing the size 20 trades at a time until you notice that a loss produces a change. A hesitation on the next trade, a desire to skip a setup, a physical tightness in your chest when the next signal fires, or an urge to modify your stop. The exact moment you notice any of that, any subtle change in your behavior or your emotional state following a loss, you have found your threshold, and you stay there. You do not move. You stay at that specific level until the behavioral change completely disappears. Until 29 consecutive trades at that size produce the exact same neutral emotional state as the level below it. I know what you are thinking. You are thinking this slow process could take months. You are thinking that at this rate you will never trade a meaningful size. You are thinking about the traders on social media posting their six-figure months and wondering how you are supposed to compete by trading the minimum lot size for 20 trades at a time. So let me address that delusion directly. Those traders on social media posting six-figure months are, in the vast majority of cases, not showing you the whole picture. They are not showing you the blown accounts that preceded the screenshot. They are not showing you the deep drawdowns between the highlights, and they are not showing you the excessive leverage that makes those returns possible and those losses catastrophic. They are showing you the highlight reel of survivorship bias, and you are comparing your process to their marketing. Stop doing that immediately because it is actively poisoning your trading psychology. The traders who are genuinely, consistently, year after year profitable are not posting screenshots. They are sitting quietly in front of their screens executing their process with the kind of calm that would bore you to watch. They are trading a size they are completely comfortable with. They are following their rules without internal drama. And their account is growing slowly, steadily, because their edge is expressing itself over a large sample of properly executed trades. That is exactly where you are going. The path to get there runs directly through small positions, not around them. Second practice, once you have identified your emotional threshold and are trading consistently at that level, is what I call execution scoring. After every single trading session, you give yourself a score from 0 to 10. This score has nothing to do with money. It measures one thing: percentage of your trading decisions that were fully compliant with your rules. If you took 5 trades and followed your rules perfectly on all 5, your score is 10. If you followed your rules on 4 out of 5, your score is 8. If you deviated on 3, your score is 4. Math is simple, but the discipline of doing it honestly is not. Here is the key. You track this score over time. You keep a running average, and you do not increase your position size until your 30-day average execution score is above 9. Not 8, not 8.5, but 9. Because anything below 9 means you are still deviating from your rules frequently enough that increasing your size will amplify those deviations into meaningful losses. This is the exact mechanism that professional traders use. Whether they articulate it this way or not, they do not increase their size when they have more money. They increase their size when their execution quality warrants it. Money is a byproduct. The execution is the cause. The third practice is the one that accelerates everything, and it is the one most traders resist because it confronts them with exactly how far they are from where they think they are. After every trade, you write a single paragraph, not about the market, but about you. What did you feel at entry? What did you feel during the trade? What did you feel at exit? What impulses did you have that you acted on? What impulses did you have that you did not act on? Let me give you a specific example so you understand the level of specificity I am talking about. Trade 4. Shorted at the signal. Felt confident at entry. Maybe too confident. Setup looked clean, and I caught myself thinking this one is a guaranteed winner. During the trade, price moved against me by 12 pips. I felt my stomach tighten. I looked at the dollar amount of the loss and thought about moving my stop up. I did not move it. Price reversed and hit my target. At exit, I felt relief, not satisfaction. Relief, like I had escaped something. This tells me my position size might be at the upper edge of my threshold. The relief response suggests I was more emotionally invested in this outcome than I should be. I will monitor this over the next 5 trades. That is the entry of a trader who is going to make it. Not because the market analysis is brilliant, but because the self-observation is honest, specific, and actionable. That trader knows exactly what is happening inside them during a trade. They can feel the difference between appropriate engagement and excessive attachment. They are building the one skill that matters more than any other in trading: the ability to observe their own psychology in real time and adjust accordingly. You cannot develop this skill when you are overwhelmed by the size of your position. When emotional activation is too high, self-observation becomes impossible. You cannot watch yourself panic while you are panicking. You can only watch yourself manage mild discomfort while you are managing mild discomfort. Mild discomfort is what small position sizes produce, and that is the whole point. Let me talk about the timeline because I want to set your expectations accurately. and I would rather give you the uncomfortable truth now than let you discover it through failure later. If you commit fully to this process, threshold testing, execution scoring, psychological journaling, and you do it with genuine discipline and honesty, the typical timeline to reach a point where you can trade at a size that produces meaningful income is 6 to 18 months. Not 6 to 18 days, not 6 to 18 weeks, but months. The range is wide because everyone enters this process at a different point. Some traders have already built significant self-awareness, while others are starting from a place where they have never once observed their own emotional state during a trade. But the range is real, and the lower end requires total commitment. I know you are thinking that is too long, that you cannot afford to spend a year trading tiny positions while your account grows at a pace that barely keeps up with inflation. I understand that frustration, but let me ask you something. How long have you been trading already? How many months or years have you spent trading at a size that was too large for your psychological state? How many times have you blown an account, given back months of gains in a single week, or abandoned a working strategy because your execution was inconsistent? Add up all that time, all those months of emotional chaos and erratic results. You will see that this is the cost of refusing to start small. 6 to 18 months I am describing is not wasted time. It is the fastest path. It only looks slow because you are comparing it to an illusion. Starting small is the real work. It is the environment in which your brain builds the neural architecture of a professional trader. Your position size is a measure of your self-awareness, and the trader with the smallest position and the highest execution score is closer to freedom than the trader with the largest position and no process at all. Trade small, score your execution, observe your psychology, and increase size only when you have earned it.